Hello and welcome back to Board Talk. Now, if I asked you which part of the stock market should you invest in if you wanted to lose money, I bet that a few people out there would say property. The newspaper headlines are full of stories about how you can buy a house in some places in America for about £2.50 and about how UK property prices are plunging. Seems pretty grim. Yet, a little while ago, I tipped a stock in the property sector. That stock was First Property, and its boss is Ben Habib. Ben, welcome to the show.
Hi, Tom.
Now, before we go on to talking about the property market and about your company, your background, you're a very establishment fellow. You went to rugby school and you went to Britain's second best university. Exactly the same background as Evel Knievel, except, of course, he failed the Cambridge entrance exam. What made you go into property? You should have gone into sort of the diplomatic corps or something like that.
Well, I left university and joined Lehman Brothers in a fairly traditional manner, and then at the age of 23 was recruited to be finance director of a Lloyd's insurance broker. So my background really is finance. And I went into property at the request of a gentleman called John Cotler, who later on became my father-in-law. And John invited me to join him in private property development in 1994. And the opportunities coming out of the last recession just looked fantastic. And that's how I did it.
Okay, I mean, 1994, of course, was just after we'd had a major property sell-off. And we've had other guests on this programme talking about how they bought sort of slum property in Bethnal Green for 25% yields at that sort of stage. Was it that sort of bargain? Was it the fact that you felt that this was a sector you couldn't go wrong in?
Well, it was partly because prices were cheap. I don't think I was prescient enough to know how much property values were going to go up. Otherwise, we would have bought everything in sight. I'm really quite cautious, as is John. In fact, most successful property people are quite cautious. If you're to survive a cycle, you've got to be cautious. Anyone can make money on an upswing. But it wasn't obvious to people in 1994 that we were in an upswing. And what drew me into property was really John's knowledge of property coupled with my financial background. And it just looked like a really good team, and I thought I'd have a crack at it.
You say that you're a cautious man. If you're a cautious man, you're attracted to property. Surely you'd have gone and become a junior pen pusher at Land Securities, and you would by now, at the ripe old age of 41 or 42, you'd be just sort of nudging up for a board position at Landsex or British Land. Why go into a sort of small firm? That's not very cautious.
I don't think I don't think caution enters the equation there, actually. I see myself, if I were to describe myself, I'd describe myself as a cautious, professional opportunist. And it was the opportunistic side of my character that took me into property.
You mentioned earlier, by the way, that the bloke who got you into property, John Cotler, then became your father-in-law. John Cotler is obviously a very sensible man because he's a subscriber to tips.com, but has that ever caused a bit of a problem, the fact that you can't really, when you go home and in the evening, you can't really complain to the wife if you've had a problem at the office, can you?
Well, John and I worked together from 94 through to the year 2000 when I set up First Property Group, and it would be nonsense to say that we see eye to eye on absolutely everything, but to the extent that we do have disagreements, we air them very professionally and openly with each other, and we have a healthy respect for each other. So actually the answer is we've had a pretty harmonious relationship.
And he's still a major shareholder in First Property, isn't he?
He is, yeah. I think he's just marginally behind me, so he's the second largest shareholder in the group.
Okay. Now, we talked there about the property market in the UK and in the early 90s, and I do remember that time of everyone being in negative equity and then the upswings that followed. We've had clear evidence that certainly the UK residential property market and indeed the commercial property market has seen a sell-off. Values have clearly fallen. Do you think we're at any stage coming to the stage where there is actually some value there? Would you be tempted to get involved yourself? I mean, you have a small exposure, don't you?
We have a couple of properties that we own in England. I'd say that we're fundamental value seekers, which is in keeping with my opportunistic nature. And we basically sold all the properties that we used to own in the UK. We sold them during the course of 2005 and 2007. And again, I'd say that was not particularly prescient. It was simply that the market was so hot that the values being ascribed to our properties were irresistible. And similarly, we couldn't find anything to buy, with the exception of a couple of properties that we still own. So we basically got out of the UK when we thought prices were too high. And I just want to define that for you, Tom, if I may, for a second, because I think it's relevant to First Property Group. For me, a fundamental characteristic for commercial property investment, which is what we do, commercial property investment, is that yields have to be well north of interest rates. You've got to have a good cushion between your borrowing costs and the yield that your property is actually earning for you. And all through the 90s, when I was working with John, and indeed the earlier part of First Property Group's existence, that was the case in the UK. But that changed in 2004. Sentiment got ahead of fundamental value, and we just couldn't justify buying property in the UK, which is why we became sellers.
I know that, I mean, in long-term interest rates now, what, 5%, slightly below 5%. Yeah. I know that Nigel Ray and Nick Leslie, who took a very similar view to you about the UK, selling their direct property exposure in 2004, 2005, or 2005-06, they have just bought their first portfolio again a couple of months ago, getting a yield of something over 6%, West End, solid covenants, upward-only rent reviews. Are you tempted now to think that there may be just a little bit of value in the UK?
I have a very large amount of respect for the two individuals you just mentioned, and no doubt there are deals to be done on a case-by-case basis. But I think, speaking of the UK market broadly, I'd say this is not the time to come in. Yields are still very low in comparison to interest rates. Interest rates are actually, borrowing costs are up at about 7% when you take into account your margin as well as the elevated level of 3-month UK LIBOR. And that means it's not really interesting to buy a property unless it's yielding 8.5. And with a backdrop to that, you've got a weak UK economy, potential for voids, potential for rent reductions. So that it's not terribly enticing as a market. No doubt there are deals, and I'm sure the deal that Nick and Nigel did is a very profitable one, will be a very profitable one for them. But we're not attracted wholesale back into the UK market at this stage. Okay.
Now, most of your business is now done in Poland. What is the attraction of Poland?
Well, when we were...
Is it a Eurozone interest rate, by the way?
Well, Eurozone interest rates helps a lot. Eurozone interest rates, by comparison, are down at 4%. 3-month Euro LIBOR is actually elevated, like all interest rates are, at about 4.8. That's part of the reason we're in Poland, but the real reason we're there, there's a whole host of real reasons we're there, partly to do with their macroeconomic fundamentals, which are tremendous. The country's growing at 6% per annum, GDP growth at 6% per annum. Retail spend growing at 15 to 20% per annum, which does wonders for retail rents. Rents coming off a very low base. There's a dearth of office space. So you've got a backdrop of rental growth in Warsaw and the other major cities in Poland. You've got a positive yield gap. Even though yields have dropped quite considerably in Poland, you still have a very positive yield gap between your borrowing costs and the yield at which you can invest. And so the multiplicity of these economic as well as property market fundamentals make it very attractive for us.
Is there an element there about Poland that one wonders, that there are certain one-off events? There is the fact that there are a large number of Polish people now, for instance, in London, or evidence that quite a few of them are going home because they can get better schools in Warsaw. Yeah. But there are large numbers of people in London. They must be sending back huge money flows to the domestic Polish economy. Presumably, the EU is doling out grants left, right and centre. Are those sort of aspects sustainable, or might they end at a certain point in the future?
Well, that's absolutely right. I mean, you've hit on two key aspects about the Polish economy, and there is a political dimension to what's happening in Poland in a way, perhaps, that we're not used to seeing in Western Europe. And to put what you've just said into context, the GDP of Poland is roughly 50 billion euros a year. And last year they received 10 billion in foreign direct investment, 4 billion from receipts from Poles living abroad, and another 4 billion from the EU. So about 40% of their GDP was represented by money coming into the country, and that's a huge investment. The question you're asking is, will this continue? Well, GDP growth was 6% per annum. The Poles are extremely industrious, very well educated. even though wage growth has been quite dramatic in Poland, they're still very cost effective. They have a vibrant agricultural economy, a vibrant industrial economy in sharp contrast to the UK. And they've become a choice location for business process offshoring. So actually, I don't see. I think their growth rate will probably slow as the world's growth rate slows, but they'll have a much better growth rate than we will in Western Europe.
What's the corporation tax rate in Poland?
Is that 19% flat?
So that's far more attractive again, in terms of where people would want to set up to do business. So it's 10% more attractive than doing business in the UK.
Absolutely, and it's been one of the depressing aspects of the UK that we've gone from being a low-tax jurisdiction 10 years ago to actually being one of the highest tax jurisdictions in Europe now.
Given what you say about Poland, that the dynamics are still favourable, but we do have this issue of wage inflation, would there be a time when you might think about moving? I know you've got a couple of things in Romania, moving further east to Europe, to places where, just as people are now saying, China might become a bit expensive, so you'll go to heaven knows where. But is going to possibly be a process of moving east from Poland in due course, or do you need that sort of local infrastructure?
Well, it's important to us. We have a philosophy of managing all the properties that we own. We don't like subcontracting that to third parties. And so if we were to set up shop meaningfully in any one jurisdiction, we'd want to set up our own office with our own employees. And that does create a degree of difficulty in moving from one country to another. But it's by no means insurmountable. We set up our office in Poland within a period of 6 months. We may move east. We may actually move west. America may be a more compelling investment proposition before the UK becomes an interesting proposition.
America, I mean, we've discussed this here slightly oddly with Boris Adlam. Why would America be a more compelling proposition than Britain? Is it just because values have fallen so fast there?
Values have fallen so fast, and you can't underestimate the importance of the American economy to the world. People talk about China with great sort of adulation, but the GDP of America, I'm sorry to go on about GDP figures, but they're sort of hot on at the forefront of my mind. The GDP of America is $17 trillion. China is about $3 trillion. There's a huge difference in the size of the economy. America is a force to be reckoned with. And yes, it's suffering considerably at the moment, but the dollar's very weak, interest rates are very low, and there will be a time where it'll be compelling to go back and look at the States.
And America, one would have thought, would be fundamentally is a more business-friendly climate than Western Europe. So that must sort of create the demand for business space.
Absolutely. It's very easy to go and do business in America. The minute it looks right, we could move in.
Okay, but in case people think that you actually invest your own money, your business is managing large property funds which do the investment. Who has backed your funds to date?
Well, we manage 4 funds at the moment, 3 on behalf of high net worth individuals, and the 4th, which is our largest, on behalf of a pension fund called University Superannuation Scheme.
My dad's my pension. Yeah, make sure you don't do anything foolish.
Well, we've done pretty well for them so far. Last year, for the year to 31st March 2008, we returned 40% on equity for them, in sharp contrast again to the UK property market.
So, in terms of sort of broadening that base, presumably that one of the ways which you can expand the fees you earn is by organic growth of the funds you currently manage, but you must at some stage be looking to launch other funds.
Absolutely, we are. And what's interesting is that I had expected the markets for new funds to be closed, but I am advised that there is money searching for good investments, and when we're virtually fully invested on the USS fund, we will be looking to raise a new fund.
In terms of being fully invested on that fund, how much have you invested, and how much do you need to invest?
Well, because of our good performance, we slightly created a higher hurdle for ourselves. We had anticipated the fund would be about a £400 million fund, so we should have been half invested at 200 million. But we're up at 270 million on behalf of USS, and we're still only half invested because the 70 million is really as a result of growth in the fund. Mm-hmm. So to answer your question, we're sort of half invested. We've got a number of very interesting propositions on, and I imagine we'll be fully invested in the next 12 to 24 months.
So at that stage you will launch a fifth fund?
Absolutely.
One of the other attractions of your company, apart from the underlying business model, is that you've got cash and what I would take to be cash equivalents of about 12 million quid, which is just under 2/3 of your market value. What could you do with that money? And do you think it's right for a company to sit on the cash? Shouldn't you be returning to its rightful owners, including you and your father-in-law?
Well, I do believe all companies should be well funded. There are three aspects to a good company in my view. It's a good business model, good management, and a good balance sheet. And we will want to retain the strength within our balance sheet. We do have a property trading aspect to our business, and we do come across properties where we feel we can add value quite quickly, stuff that isn't appropriate for our funds, but which we can trade in ourselves. And we've done very well doing that. So there is a need for capital in the business. But we're very keen on paying dividends. I believe fervently in the payment of dividends, irrespective of whether a company is a growth company or ex-growth. We're a growth company. But we will be looking at a progressive dividend policy as our profits grow.
Presumably in the current climate, it must be a lot easier going to sleep at night knowing you've got significant cash backing than not having it.
Absolutely.
Okay, final question. You're not that much older than me, so retirement should, in theory, certainly judging by your father-in-law, be decades and decades and decades away. But is there a game plan? Is there a sort of 5-year game plan? Nigel Ray would always say, before you make an investment, ask the chap how we're all going to get out and make lots of money. What is the ultimate game plan?
Well, the game plan at the moment is to create a company big enough to have liquidity in the stock so that shareholders can trade in it freely. We're quite an illiquid stock at the moment. And I think we've got to get the market value of the company up. We have no particular plans for acquisitions, but if acquisitions should come past our radar, we'll have a look. There's a lot of organic growth to be done. I think the company is it's undervalued.
Mm-hmm. We all think our companies are undervalued. But presumably, what you believe that in terms of getting the market value up, a large part of that would be if you get the current Fund 4 fully invested and you launch another fund of a similar size. We can all do our sums about what your management fee, what earnings per share would be.
Yeah.
That on its own should, in an ideal world, see a significant uplift in the market value.
Absolutely.
Do you think that would be a platform for you doing corporate deals, or when we're honest amongst ourselves, is the ultimate end game that you would be taken out, as always happens with property companies? You always end up buying each other.
Well, I've got no intention of selling. Someone would have to offer one hell of a good price to entice me down that road. But at the moment, that's not on the agenda. We feel very strong. We've made the right decisions over the last few years, in contrast to some of our competitors. We've got out of the UK. We're in a very good position in Poland, and we would seek to capitalise on that position.
Okay, sounds good. Thank you very much for coming in.
Thank you very much.
I hope you enjoyed that. See, not all property stocks are in the mire. Join me, same place, same time, next week here on Sharecrazy for Board Talk. See you then.